Topic 17, Ending the Venture. This will be the last topic of our course, and at the end of this topic, students will be able to illustrate differences in alternative types of bankruptcy, illustrate the survival tactics of entrepreneurs in case of bankruptcy, understand the warning signs of bankruptcy, appreciate turnaround entrepreneurs, examine the options in providing for the succession of a business to family or non-family members. Failure is not uncommon in many new ventures. The failures are personally painful for the entrepreneur and too often could have been prevented by paying more attention to certain critical factors in the business operation. Some lessons can be learned from those who have experienced bankruptcy. Many entrepreneurs spend too much time and effort trying to diversify in markets where they lack knowledge, and they should focus only on known markets. Bankruptcy protects entrepreneurs only from creditors, not from competitors. So it is difficult to separate the entrepreneur from the business. Entrepreneurs put everything into the company, including worrying about the future of their employees. And many entrepreneurs do not think their business is going to fail until it is too late. They should file early. Bankruptcy is emotionally painful. Going into hiding after bankruptcy will be a big mistake. Bankruptcy needs to be shared with employees and everybody else involved. So what are the alternative types of bankruptcies? According to the Bankruptcy Act of 1978, it was designed to ensure a fair distribution of assets to creditors and to protect debtors from unfair deletion of assets and to protect them from unfair demands by creditors. The Act provides three alternatives. The first one is the reorganization or Chapter 11 bankruptcy. This is the least severe alternative to bankruptcy, and in this situation the courts try to give the venture time and breathing room to pay debts. Usually this situation results when the venture has cash flow problems and the creditors begin to pressure the firm with lawsuits. The entrepreneur feels that sometime the business can become more solvent and liquid in order to meet its debt requirements. Then a major creditor or any party who has an interest or a group of creditors will usually present the case to the court. Then a plan for reorganization will be prepared to indicate how the business will be turned around. The plan will divide the debt and the ownership interest into two groups: those who will be affected by the plan and those who will not. Then it will specify whose interests will be affected and how the payments will be made. Once the plan is completed, it has to be approved by the court. And all bankruptcies are now handled by the US bankruptcy courts, whose powers were restructured by the Bankruptcy Amendment Act of 1984. The plan reflects any one of the combination, that is extension. This occurs when two or more of the largest creditors agree to postpone any claims. This acts as a stimulus for smaller creditors to also agree to the plan. Substitution. If the future potential of the venture looks promising enough, it will be a possibility to exchange stock or something else for the existing debt. Composition settlement. The debt is prorated as a settlement for any debt. So 20 to 25% of the firms that file for bankruptcy according to Chapter 11 may overcome the situation and come out successful. The second alternative is the extended type payment or Chapter 13 bankruptcy. And if an entrepreneur has a regular income, it is possible to file for extended time payments as long as the unsecured debts are less than $100,000 and the secured debts are less than $350,000. This option is only available for individual proprietorships and it is strictly a voluntary form of bankruptcy. Under this plan, the entrepreneur files a plan for the installment payment of outstanding debts. If the courts approve, it binds the creditors. The claims can be paid in the following order of priority. It starts with the secured creditors, then comes the administrative expenses, then the claims arising from operation of the business, then the wage claims up to $2,000 per person, then will be the contribution to employee benefit plans, then move on to the claims by consumer creditors, taxes, and the general creditors. The third alternative to bankruptcy would be the liquidation or Chapter 7 bankruptcy. This is the most extreme case of bankruptcy, which requires the entrepreneur to liquidate either voluntarily or involuntarily all the non-exempt assets of the business. If the entrepreneur files a voluntary bankruptcy petition under Chapter 11, it constitutes a determination that his venture is bankrupt. Usually, the courts will also require a current income and expense statement. Involuntary bankruptcy is a petition filed by creditors without the consent of the entrepreneur. Normally, reorganization under Chapter 11 or an extended payment plan under Chapter 13 takes a significant amount of time. And the key to enhancing the bankruptcy process is keeping creditors abreast of how the business is doing and stressing the significance of their support during such a process. Bankruptcy should be the last resort for the entrepreneur. Every effort should be made to avoid and keep the business operating. What are the survival tactics of entrepreneurs in case of bankruptcy? Bankruptcy can be used as a bargaining chip to allow the entrepreneur to voluntarily restructure and reorganize the venture. File before the venture runs out of cash or has no incoming revenue or the expenses are not protected by bankruptcy. Do not file for Chapter 11 protection unless the venture has a legitimate chance of recovery. Be prepared to have creditors examine all financial transactions for the last 12 months, seeking possible data fraud. Maintain good records. Understand completely how the protection against creditors work and what is necessary to keep it in place. If there is any litigation in existence, transfer it to the bankruptcy court, which may be a more favorable forum for the entrepreneur. Focus efforts on preparing a realistic financial reorganization plan. It provides an opportunity to settle debts prior to bankruptcy court legal proceedings. Basically, it warns that the entrepreneur will be declaring bankruptcy in the near future. Its intent is to make a Chapter 11 filing more predictable and thus hopefully more successful process. It can allow a company to emerge from bankruptcy in 4 to 9 months rather than more common 9 months to 2 years through a regular route. However, this may label an entrepreneur as a failure in the market. That cannot be avoided. What are the warning signs of bankruptcy? When bankruptcy is on the verge of happening, some telltale sales do occur. These warning signs should act as indicators to take either preventive steps or, if it is too late, at least make the organization prepare itself for the final eventuality and try to minimize the damage. Such warning signs can be as follows. Management of finances becomes lax, so that no one explains how money is being spent. Directors cannot document or explain major transactions. Customers are given large discounts to enhance payments because of poor cash flow. Contracts are accepted below standard amounts to generate cash. Bank requests subordination of its loans. Key personnel leave the company. Lack of materials to meet the orders. Payroll taxes are not paid. Suppliers demand payment in cash. Increase in customers' complaints regarding service and product liability. So these warning signs should definitely be a wake-up call for an entrepreneur. Now, who are turnaround entrepreneurs? Bankruptcy and liquidation does not have to be the end for an entrepreneur. History is full of examples of entrepreneurs who have failed many times before finally succeeding. The entrepreneurial characteristics show that they learn from their mistakes, and investors often look favorably on someone who has failed previously, assuming that he will not make the same mistake again. Business failure does not have to be a stigma when it comes to seek venture capital. History provides examples of business turnarounds and that have made some firms to survive near bankruptcy and reach out into success stories. All this is due to the efforts of the entrepreneurs who are now large business houses, which were once small units having trouble at the initial stages. Succession of a business. New firms will be passed on to family members. If there is no one in the family interested in the business, it is important for the entrepreneur to either sell the business or train someone within the organization to take over. An effective succession plan needs to consider the following critical factors. The role of the owner in the transition stage. Will he continue to work as full-time, part-time, or will he completely retire? Family dynamics. Are some family members unable to work together? Income for working family members and shareholders. The current business environment during the transition. Treatment of loyal employees and the tax consequences. Transfer to non-family members. Often, a member of the family is not interested in assuming responsibility for the business. When this occurs, the entrepreneur has three choices. He can train a key employee and retain the same equity, retain control and hire a manager, or sell the business outright. Passing the business on to an employee ensures that the new principal is familiar with the business and the market. The experience of the employee minimizes transitional problems, and finding someone to manage the business in the same manner and with the same expertise as the entrepreneur may be difficult. If someone is found to manage the business, the likely problems are compatibility with the owners and the willingness of this person to manage for any length of time without a promise of equity in the business. The last option, often referred to as harvesting, is to sell the business outright to either an employee or an outsider. The major consideration in these options are financial, which will likely necessitate the help of an accountant and a lawyer. In conclusion, it can be said that any entrepreneur who starts a business should pay attention to as well as learn from the mistakes of others. There are certain requirements that can help keep a new venture going and reduce the risk of failure. Avoid excess optimism when business appears to be successful. Always prepare good marketing plans with clear objectives. Make good cash projections and avoid capitalizations. Keep abreast of the marketplace and identify stress points that can put the business in jeopardy. With this, we conclude our course, Introduction to Entrepreneurship, and that should be our learning. Thank you.